Well, welcome everyone to the United Church Funds Town Hall. Looks like we have most people in the room now, and I welcome you. I'm Charles Buck, President and CEO of United Church Funds. I'm delighted to be joined by the UCF team, who you'll see in just a bit. We're going to share with you the latest news and updates from UCF. Before we get started, I need to let you know that while we aim to be as informative as possible, everything that you hear and see in these town halls is for general knowledge and use only, and nothing we say should be construed as giving any specific legal, tax, investment, or financial advice. We're going to start off today with a poll to see who's here and also to see how you're doing. So if you would, let's go to the poll questions here. Popping up on your screen should be two questions. First, how would you describe your role in your church or organization? And then the second question, you may have to scroll down for this. How are you feeling about the state of our world or nation or economy? This second question is our version of something called the MCSI, not to be confused with the MCSI, but this is the Michigan Consumer Sentiment Inventory I'm talking about. It comes out every month from the University of Michigan. In this case, tell us how you're feeling generally. And if none of these words work for you, check other, and I invite you to type in the chat the feeling or a word that comes to mind. And as you're filling out the poll, I want to let you know that these town halls are recorded so that you can review it afterwards and also share with others in your church or organization who are not able to join us live. The benefit of joining the live session is that you can ask questions of our team in real time, and you can do that by clicking on the Q&A box and typing it in at any time during the webinar. As time allows, we'll answer as many as we can. And if we miss yours, we'll reach out afterwards. Well, let's see what we've got here. So the first question, who's in the room? We've got mostly trustees or board chairs, board members, as well as an investment committees, endowment committee chairs, members. That's who we typically expect, but it's wonderful to see also pastors, ministers, CEOs, or presidents of organizations and congregants, and whoever the other is, you're also welcome. So thank you for joining us. And in the second question, how are you feeling about the state of our, whatever it is, world, nation, economy? Depressed or anxious by far, over half of us. Confused, 24% is pretty strong. We got 14% who are hopeful or optimistic. That's wonderful. Uh, Interestingly, no one is apathetic, which means we all care, and I think that's a good sign. No matter how we feel, we can't afford to be apathetic during these times. And the other, I can't see it on my screen, but I will take a look at it later. I will tell you that for me, the feeling that I have is confused, also bemused, and even sometimes amused. I don't need to tell you, it's been a wild ride this last quarter. In fact, it's been a wild first half of the entire year with all the changes in Washington. Sometimes feels like the strategy, if there is one, is to keep us off guard. And that doesn't make it very easy to be responsible stewards of assets when we have to deal with mixed signals, daily policy shifts, and ongoing geopolitical tension and intrigue. I don't think we've ever seen so much tumult and volatility compressed into so short a time. And at this point, it looks like more of the same for the second half of the year. So if we could go to the next slide. Our UCF team is here to try to make a little sense of it all. Here's what's going to happen today. They're going to share what we've been doing, what we're expecting. We don't ever claim to have the answers or know the future, but we are promising to be responsive and responsible stewards of your assets every step of the way. Before we go to organizational updates, I want to say thanks to our marketing communications team of Debbie Wibowo and Adam Sank. They're the stars behind the scenes making these town halls possible. Thank you, Debbie and Adam. And I want to say thanks to all of you for joining us and entrusting UCF to be partners with you in the stewardship of your assets, all for the sake of God's mission. I'm pleased now to introduce Kelsey Rose of our Institutional Relationships team to bring you organizational updates. Kelsey?
Thank you, Charles, and hello, everyone. I'm excited to dive into a few exciting organizational updates for the quarter at United Church Funds. First, several of us from the UCF team attended the UCC General Synod in Kansas City last month. We had a great time seeing so many of our old friends and making new friends along the way. And we also presented two excellent workshops at Synod. We know that not everyone who attends General Synod, and even those who do attend, are not able to check out as many workshops as they may have wanted. And that is why UCF chose to record both of our workshops and make them available on our website for all. More Synod highlights and these workshop recordings are available in the link provided in the presentation, which you will receive a copy of following this town hall. And the link is also provided here in the chat too. And last month, we also welcomed two new client services associates, Melissa Chan and Shirin Kothari. Making sure all UCF clients receive dedicated and personalized service is a top priority for us, and we are thrilled to have Melissa and Shirin on the UCF team. In addition to new UCF staff members, Bernard Wilson is the new board chair of the UCF Board of Directors. Reverend Dr. Bernard Wilson brings many years of experience as a retired military chaplain and as a minister, as well as extensive nonprofit leadership and board service involvement. We are also excited to welcome new members to the UCF Board of Directors, Derek Elliott and Julia Gaughan, as well as Jasmine Coleman Quinterly, who is the new ex officio member through her role as board chair of the United Church of Christ Board. You can read the bios of our new staff members, board members, and board chair, as well as bios on all staff and board members through the link found in the presentation deck that will be sent to you, and the link of these bios are sent in the chat too. And lastly, the UCF team is going to be present at several events this fall, which you can see on the screen here, and perhaps we will see you at one of these events. As a recognized leader in responsible investing strategies, these events are great opportunities to stay informed about trends and changes in the responsible investing landscape, and also to share on UCF's experiences. And on that note, what a great segue into our updates on responsible investing with Noah Tabor, our general counsel. So Noah, over to you.
Thanks, Kelsey. Hi, folks. I'm Noah Tabor. I'm filling in for Matthew Illian today. Lots going on in the world of responsible investing. We're so excited to provide you with some updates. But first, let's do a couple poll questions. Soon you will see a couple poll questions on your screen. There's two again. The first being, which of the following did not happen at General Synod? I have some options there. And the second is, how does your church organization react to resolutions of General Synod? We'll give you some time to answer. I think there's some fun answers there. I'm particularly interested in one that's invoking my name, but we'll see the results here. So please do give both questions an answer here. Okay. Wait for those results to pop up. There we go. Good. Okay, some good answers here. The answer that didn't happen, General Assembly, is actually the police did not arrest several delegates at a protest march. So that is the winning selection. And yes, Noah Tabor did serve ice cream. It was quite the hit and quite a bit of fun. Next, in the question, how does your church organization react to the resolutions of General Synod? We hear, goodness, so we hear them, and it's up to each person to do more. Mentioned from pulpit and meetings, very good. It's nice to see some good responses of different ways that these resolutions are being used. Very helpful, my goodness. Okay, let's move on to our actual updates here. First, General Synod. As folks know, General Synod is now the tri-annual gathering of the UCC. This is an incredible opportunity to see the vitality of the church as we worship together, conduct the business of the church, and build lasting relationships. It is very much the UCC Super Bowl. A big part of General Synod is the resolution process. Resolutions are how the church speaks and provides missional guidance for our denomination. Resolutions go through a thorough committee process before being voted on by full plenary. We track 2 resolutions of note through the committee process, one on immigration and another on Israel-Palestine. The immigration resolution was broad, but the key points for UCF are on the slide relating to investing in private prisons and detention centers. Importantly, we shared that with the Committee of Jurisdiction that UCF already has a screen in place for private prisons and detention centers. Another resolution, one concerning Israel-Palestine. The resolution calls for the end of the genocide occurring in Palestine. While no direct impact on UCF, we actively track this resolution for its missional importance. Worth highlighting here are 2 things. First, UCF already restricts investment in companies that cause or contribute to human rights harms. And second, UCF already restricts investments in companies that derive 10% plus of revenue from weapons systems, components and support systems, and service or nuclear weapons. Both of these resolutions pass with significant majorities. Let's head to the next slide. Next is a little recap of a very successful 2025 proxy season. UCF came to agreements with the companies listed on this slide. Coming to agreements with companies versus taking an issue to a vote often leads to more expansive company commitments. We are so proud of the headway made on some important issues this season, especially on lobbying transparency. Let's head to the next slide. UCF was a co-filer with some of our partners on 2 resolutions that went to a vote at shareholder meetings. The results are captured on the slide. While not the numbers we hope for, it still is market progress. Let's head to the next slide, and this is a fun one. So excited to talk to you for a little bit of our partnership with Migrant Justice. Since 2019, Migrant Justice has urged Hannaford supermarkets to join the Milk with Dignity program. Hannaford is a major buyer of dairy products sourced from farms where workers have reported grueling and unsafe work conditions. In April, UCF invited Migrant Justice to represent UCF at the annual general meeting of Ahold Delhaize in Amsterdam to amplify the voices of immigrant dairy farm workers and call for remedies to serious labor abuses within the dairy supply chain. You can learn more about this by listening to Marita from Migrant Justice on UCF's Just Investing podcast. There's a link on the slide which will be included in the follow-up materials. Now let's go to the next slide for another fun one near and dear to my heart. UCF hosted its first day at the Capitol. This June, UCF headed to Washington. We had the opportunity to partner with UCC's DC office and US Civ, the Sustainable Investment Forum. This powerful trip was a tangible example of our growing commitment to advocacy. We had educational and relationship building meetings with 4 congressional offices, both Democrats and Republicans, and 1 meeting with the committee staff. We had tremendous feedback on our work and created invaluable relationships. Certainly much more to come in this arena. And now I'll turn it to Matt for some market updates.
Noah, thanks. Appreciate it. And first of all, Noah's ice cream at General Synod was excellent. If anyone was there and enjoyed it, we were able to bring some Ben & Jerry's sustainably sourced ice cream to the folks there to highlight our work with that migrant justice organization in Vermont. And as Noah leaves the screen, I want to wish him a happy birthday. He's spending part of his birthday with us in service to our clients, and we're certainly grateful for his service to the organization. You know, as Charles mentioned at the beginning, we're hoping to make some sense of what has been a very volatile first half of 2025. And we've seen some volatility to the downside in the first weeks of April and in parts of the first quarter. And we've seen some volatility to the upside as markets continue to make new highs. And so as we fast forward to the next couple of slides, we're going to hit some key points, and then we're going to break these down with some charts and graphs and some conversation with our with members of our investment team. As you can see there, as I go down this list, international and U.S. markets have had an exceptional start to 2025, despite some of that volatility. Markets overseas have benefited from a weak U.S. dollar, and U.S. markets, while again have been volatile on trade talks, tariff talks, and global conflict, overall have been positive for the first half of the year. We've talked a lot about with our clients over the last couple of years about market concentration, particularly in U.S. large cap, where we've seen a very small number of companies, often referred to as the Magnificent Seven, be the bulk of the return or lead the bulk of the return in huge indices like the S&P 500. We saw a broadening of the leadership of the S&P 500 early in 2025, but in Q2, the technology sector and that communications sector, where those Magnificent Seven companies, where they lie as far as the sector goes, or sector allocation goes in the S&P 500, they were the leaders again. And so something we want to be able to talk about with you today. We're going to talk a little bit about fixed income. And over the most of the last decade, fixed income has not been what we would refer to as a participating asset class related to the return of diversified portfolios. Over the last couple of years, as we've seen rates and yields come up, fixed income once again is generating competitive rates of return. And fixed income has done its job in 2025, being to some degree a downside hedge to equity volatility. We're going to talk a little bit about how fixed income fits into diversified strategies across the UCF balanced funds. And then lastly, we're going to talk about some sort of more global macroeconomic conditions and some of the geopolitical risk and global conflict that we're watching very closely. And as we meet with our investment managers regularly, these are the types of things that we're talking about as we're thinking about strategy into the second half of 2025 and into 2026. And as always, I just want to remind all of you that we at United Church Funds not only remain diversified and carefully watching portfolios, we also remain very committed and in covenant with ensuring that the portfolios that we manage on behalf of all of our clients represent the values of our clients. And so as we navigate our nearly $1.3 billion in total assets, we're doing so not only with an eye to markets, but also with an eye to ensuring that we remain that sustainable investment partner that you have come to trust. As we go to the next page, we're going to take a look at some index returns for the quarter and through the first half of the year. And on the left there, you'll see a variety of indices, benchmarks. The top half of that list, or the top third of that list, are equity benchmarks. The middle few there are fixed income, and then towards the bottom, you'll see some commodity and sort of alternative asset classes. And you can see when you look at the S&P 500 year to date, returning about 6.2%. The Russell 2000 small cap stocks in the U.S. is the only asset class year to date that has a negative return. But you can see that the bulk of the return year to date happened in Q2 as markets caught their footing after a very volatile start to Q2 with the announcement of the new tariffs and trade talks from the White House. And we moved past that in May and June were very positive months, both for U.S. markets as well as international markets. And you can see there, year to date, the Europe and Far East, the EFA index, which includes developed markets overseas, led all of these asset classes or all of these equity classes with about nearly a 20% return. When you look down to the bottom right of graph, you'll see the treasury rates there. And as of June 2025, the 10-year treasury, often referred to as the risk-free rate, sits at about 4.25%, has been fairly consistent over the course of the first half of 2025. Of course, we'll talk a little bit about where we think interest rates might be going in the second half. So with that, I'm going to pause, and I'd like to introduce my colleague, Stacy Pettis, our Executive of Institutional Relationships. And I would like to introduce Lon Kai and Manothi Dhanaraj from our investments team. And Stacy has a question for Lon, I believe, to kick us off. Stacy?
Great. Thank you, Matt. And thank you all for joining us. as we take a look at this very interesting chart, and we'll talk about it in a little bit more detail, what may have been somewhat surprising is that the international equity sector has been the major contributor of returns year to date. In the face of pressures from US tariffs and unfortunately global conflicts all over the world, the MSCI EFA, which is the index for large and mid-cap developed markets, returned nearly 20% in the first half of 2025. I think we've been waiting for the moment for international equity to pop again. So, Lon, I'm going to ask you a question as it relates to UCF's global equity mandate amongst our balanced funds. We know that your team has the ability to underweight and overweight US versus international markets. Can you walk us through some of the key drivers of international outperformance year to date in 2025, and also a couple of themes that may impact domestic versus international equity allocations in the future?
Sure. Thank you, Stacy, and hi, everyone. So the first half of the year, international outperformed the US. And then, Stacy, you mentioned the word surprising because it hasn't happened for the last 15 years. And then that becomes surprising. There are two primary factors drove the international market outperform the US. One, Matt already mentioned in terms of the US dollar. US dollar weakened over 10% for the first half of 2025. And the second factor is really kind of the international stock market was traded at widest discount at the end of 2024. And then coming into 2025, there is some hope for government spending. And then also some countries has already started monetary policy easing. So there is a multiple expansion within those stock markets. In general, we look at two elements that is important to decide between international market versus the US market. One is really kind of the economic condition and the earning growth for international market versus US. The other element is US dollar. And when you look at this chart, when the purple area is above the line, and this is a 3-year rolling return difference between international and the US market. When it's above the line, meaning that the international market outperformed the US. It hasn't happened for the last 15 years, but there were periods between 2002 and the beginning of 2008, international market did outperform US. And during that period, US dollar depreciated over 40%. So history may repeat.
Well, thank you, Lon. Thank you for that context. I'm going to pose the next question to Minoti Dhanaraj from our investments team as we look forward to the next slide about S&P 500 concentration. A theme in which Matt mentioned before is that, and also this theme has been present for over the past 5 years, is that there's growing leadership of the Magnificent Seven stocks in the S&P 500. And the dominance of these 7 companies within the key indexes has been raising concerns over time about an overconcentration that exists. As the data in the top left chart indicates, over the past 3 calendar years, those 7 companies contributed to over half of the total return of the S&P 500 company index. Manoti, year to date in 2025, we've been seeing the broadening of leadership in the S&P 500 index, but the Mag 7 still contributing to over 20% of, or about 20% of the returns. What are a couple of sectors or groups of companies that your team has an eye on for future returns as it relates to our portfolios?
Thank you, Stacy. Good question. So as allocators, we really believe in diversifying our portfolio, especially given shifting markets and importance of diversification across geographies, asset classes, styles, etc. Year to date is a great example, as you noted, with the broadening of the market, including a shift in the first quarter to value, then back to growth in the second quarter, with international outperforming year to date. And so thus it's really important to stay diversified. That being said, we do believe there is, a strong possibility that we'll continue to see some leadership in technology with advances in artificial intelligence. Though, you do need to keep an eye out for valuations, especially with economic conditions starting to slow down. Additionally, we believe sectors such as utilities to support the electrification of the economy, healthcare with the aging population, infrastructure as global supply chains restructure, and other sectors will continue to lead. Thus, we as allocators really try to pick the best active managers to pick the best stocks to invest in various markets.
Understood.
Thank you.
Thank you, Minoti, for that context. I'm going to turn it back over to Matt to ask the next question and walk through the following slide.
Great. Thanks, Stacy. And Minoti, thanks for that answer too, especially as we talk about how we allocate amongst equities as we kind of wrap sort of those couple of slides. It is interesting to note we do use active managers, of course, and then we also have some managers that have some sort of passive layers into what they're doing. And I'm thinking about, for example, PGIM Quantitative Solutions, who's been our equity manager for the Beyond Fossil Fuels Fund, and just as an opportunity to highlight that fund being, have exceeded its net of fee performance, exceeded benchmark over 1, 3, 5, and 10-year time horizons for the equity strategy. And the balance fund has had sort of similar returns as well. So for those clients that are listening in, for that, we have this really interesting platform of active managers, some passive, but then really focusing those passive managers on enhanced strategies to help them find some alpha in the portfolio. I do want to remember, before we go to this slide, I do want to remember to tell all of our audience that as you have questions, as we go through the last couple of slides, the Q&A box is there. For that, I encourage you to put your questions in there. We will try to get to as many as we can before our time is up for this webinar. So if you do have questions, really appreciate you using that. I know several of you used it on the question about sort of how you were feeling about the economy. And Bing Heckman, our friend from Palo Alto, California, defined that, by the way, used the Q&A chat and said the most interesting time in history despite major concerns. It's kind of interesting, kind of sort of encapsulates a little bit about what we've heard from our clients. So again, as for those that are in attendance, if you've got questions, and I say that because there'll be lots of folks that are attending this, watching the recording in future days. But if you're here live with us right now, we encourage you to use the Q&A box if you've got questions, and we'll try to get to as many as we can. Okay. With all of that said, Minoti, let's get back to the slides and talk a little bit about fixed income. I know bonds have been an exciting asset class over the last decade, and I say that sort of tongue in cheek. We talked about that. It's been, the era of interest rates at zero and fixed income giving us these low single-digit returns appears to be over, at least for the last couple of years, and maybe for the foreseeable future. Bonds have held sort of two prime functions in our balanced fund strategies. One is to generate a sort of a non-correlated return to equities, obviously. So we diversify the portfolio that way. But then also we get a little bit of a downside hedge. So, the idea that there's a little non-correlation there there's non-correlation to equities allows us to diversify portfolios, across these two asset classes for the bulk of our clients. And we know that there's several factors that sort of move the bond market. Interest rates has been the one that's in the news today, right? What's the Fed going to do at their September meeting? What are they going to do in future meetings? Are they going to move the needle? How is that all going to work? How is that going to impact equity markets? How is that going to impact yields moving forward? But what I would ask you to do is to give our audience today just sort of a high-level overview of some of the drivers that move the bond market and some of the things that you and your team are working with our bond managers as they sort of seek to position portfolios on behalf of our clients.
Thank you, Matt. So as you noted, interest rates with, September with the Fed possibly reducing rates by 25 basis points. But beyond just interest rates being a driver, the starting yield is, probably the principal driver at the beginning when you purchase a bond, and then the yield curve, credit spreads, depending on the issuer's risk, inflation expectations, as you noted today in the CPI print, geopolitical risks with tariffs and other factors. And as you can see on this slide, currencies also impact bonds, where we saw year-to-date emerging markets local currency debt do very well as the US dollar weakened. So with all of that said, you should really feel comfortable, and our clients should feel very comfortable, because our internal fixed income team has been with following the markets for decades now, following these different drivers and through various different market environments. So you can feel comfort with the teams that we have and the other managers that we have selected.
Yeah, I appreciate you saying that. We talk a lot in portfolio reviews with clients about equity managers, as we should. We have more equity managers than we do bond managers, but it is really important to note and highlight what the work that Nuveen is doing for us, the work that the pension board's fixed income team is doing for us. We've got slivers of emerging market debt and some PIMCO ESG fund in there as well. So thanks for highlighting that. I appreciate it. Thank you, Minothi. I'm going to turn it back over to Stacy for one additional question to Lon, and then we're going to kind of wrap up and head to Q&A. Stacy?
Great, thank you. Our clients have heard a lot about inflation over the past 4 years. Within these quarterly town halls, we have found it to be an imperative part of a topic that we should unpack for you all. And in 2021 and 2022, we talked to our clients about swift increase in inflation in the post-COVID years. And we also spoke about the decrease that had happened in inflation within 2022 and 2023 and 2024. Lon, this question is for you. How is inflation impacting our decision-making today regarding asset allocation in diversified portfolios such as ours?
Yes, Steve, another very good question. Inflation is real. Not only affect us as allocation decision, it is real because it affects everyone's purchasing power. And in terms of asset allocation, when we look at inflation, it is a key element for central banks to decide on the monetary policy. Inside the US, the Federal Reserve Bank has dual mandate, maximum employment and price stability. Outside the US, a lot of the central banks only focus on price stability, and that's the inflation number. So when the inflation is high, the Fed and the other central banks were likely to raise interest rates, tighten the monetary situation, financing condition, and cool down the economy. And then the market will react negatively towards that we call it monetary policy tightening. If you look at 2022, on this chart, you mentioned there's a high inflation after the pandemic, 9%. And then because of that, Fed increased interest rate at every single meeting for 7 times, a total of 4%. What had happened to the market? Both bond market and the equity market sold off double digits. Now, this year, despite all the uncertainties, the market went up. Part of the reason is that earning, particularly in the US, has been very strong. But also, when people look forward, as Minothi talked about, and then Matt also mentioned that Fed might start to cut interest rates starting September. And therefore, some of the forward-looking is baked into the price. So when Fed start to easing the monetary cycle, So by cutting interest rates, usually the financing condition becomes much easier and then helps the financial assets.
Great. Matt, did you want to bring us full circle?
Absolutely. Thanks, Stacy. Thanks, Lon. So we're going to get to Q&A here in just a moment, but as we look at the following slide, just a reminder to our clients about how important it is to be diversified across asset classes when we see times when we're experiencing times of volatility like we are now. Both, and again, volatility can be both to the upside and to the downside. So what you see here is from 2010 through year to date 2025. You see a variety of asset classes there, sort of the quilt style of chart. And you can see what their annual return for each one of those asset classes is year over year. And then on the far left column is the annualized return from that 2010 through 2024. And you can see there, if you look at that top left column or top left corner there, you can see the U.S. large cap, U.S. small cap. Those have been the leaders over that period of time. But you can see there when you look down just a little further, the fourth highest return that you see there is actually an asset allocation strategy that's diversified across equity, fixed income, and even some alternatives. And so as we talk to our clients about the importance of being diversified, as we talk to our clients about your goals and objectives and how we should perceive market risk, we know that today's environment can be a little bit of a scary place, particularly for some of our clients who aren't used to managing assets for an institution or even maybe for themselves. I want you to see this as, and I hope that you take the last little part of our conversation here as us being a trusted partner to all of our clients, ensuring that you've got an experienced partner. We have a terrific investment team. We've got a terrific group of folks at UCF that are here to guide you through these strategies to be able to help you meet your goals and to be able to hopefully help maximize your money for mission and ministry. So with that, I'm going to pause. We're going to do a little bit of Q&A again. We've got some Q&A in the chat. So I appreciate that. I am going to throw it to right out of the gate, throw it to my colleague, Noah. Valerie Neville, good to hear from you, Valerie. Thanks for joining us from Lebanon, New Hampshire. She asked specifically if we were doing anything regarding discrimination of women and girls in Afghanistan. A great question, a really important topic. And Noah, happy to hear your response for that.
Yeah, thanks, Matt, and thanks, Valerie. That is a fantastic question. We do human rights watches generally, and we take those human rights watches very seriously. We don't specifically address this issue because we're not invested in companies doing business there. Valerie, I'd love to follow up with you offline. I'm going to drop my email in the chat. Let's connect on this and see what else we've been doing. But a great question, and we'll take more into consideration. Thanks.
Yeah. Thanks, Noah. What I would say, I appreciate you following up with Valerie. What I would also say is that across our entire platform and across our entire sustainable investment platform, we take very seriously discrimination issues across not just gender, but sexual orientation and other factors. So as we think about how companies are engaging with their employees, with their customers, with society in general, the idea that corporations that embrace diversity, equity, and inclusion and other factors, how we can work with them to help continue those efforts, we think is good work to be doing on behalf of all of our clients. Davita Crabtree had a question about, she was interested to hear about the Fossil Fuel Free Fund, the Beyond Fossil Fuels program, and to what degree it represents affirmative investment in solar, geothermal, and other truly renewable resources versus divestment from fossil fuels. That's a really good question. We have talked a lot about not only just the divestment screens, which is kind of where that strategy started, right? The idea that we are going to divest of companies that have fossil fuel reserves in the ground. We have become more sophisticated about that as we've had access to information. And frankly, as that fund has grown, let's remember that over the last 10 years, the Beyond Fossil Fuel strategy, which started with an initial $20 million in commitments from our existing investors. When we launched, we were at about 60 or 65 million. And now we sit somewhere in the neighborhood, and I see Lon on the screen. I think we're now in the neighborhood of 280 or $90 million in that strategy. So significant growth in that strategy for us and on behalf of our clients. That represents a lot of new money coming into that strategy. Also represents the fact that that fund has done exceptionally well from a market return perspective. But what we've been able to do, what that growth has been able to do for us, is to allow us to think a little bit more comprehensively about things like carbon footprint versus the index and other ways that we can measure that fund's climate sensitivity. And so I will tell you that I often tell clients, that fund is not just a simple, we're going to swap out Chevron and we're going to put in First Solar. That is not what we do in that strategy. That wouldn't be responsible from a fiduciary standpoint. But we are very sensitive to the carbon footprint of that overall portfolio. And we work very closely with our manager to ensure that we're continually looking at that fund to optimize it, not only for return, but also for its climate sensitivity. It's a great question. Another question from Kelly Dixon. With the U.S. government removing a lot of funding for green energy initiatives, how is this changing the strategy for the No Fossil Fuels Fund? In short, it is not changing our strategy. We think that our work with the Beyond Fossil Fuels approach is more important than ever. And the fund's performance historically, as we look back on the last 10 years, has been excellent. So again, as I mentioned, the equity strategy in particular, above benchmark over 1, 3, 5, and 10-year timeframes. Again, it kind of proves that type of screen does not impact, or at least has the ability not to impact performance, at least in our case. And we have been, again, we've been really happy with that performance and remain committed to that strategy as a whole. We had a question in the chat that I want to make sure that I grab here. This is from Paul Roberts. And he asks, rush of news stories describing new banking interest in crypto, largely exempt from government oversight and control, et cetera, right? The wild, wild west of the crypto world. I will tell you that we do not have any crypto in our portfolio, direct cryptocurrency. It's certainly going to change some landscapes. As a fiduciary and as a trusted partner to our clients, we will stay on top of all of that. But we don't own any direct crypto in our portfolio. And so inevitably, some of the regulations and things, to your point, Paul, as those things change, we will, or at least, as they grow or change or may impact our portfolio, we will stay on top of that. But I appreciate that question because we do know that crypto has definitely been in the news. And two more questions here. We try to keep this to 45 minutes. I see we are at 5:43 Eastern. Bing Heckman has a question. How does the asset allocation average from 2010 to 2014 compared to the ETF QQQ? Bing, that's a specific question that I'll be happy to follow up with you on. I want to make sure that I fully understand that question, and we'll be happy to get you the detail to be able to answer that. Thanks again for being on the call. And then lastly, David Harris asks, how have allocations changed as subsidy allocations by the U.S. government has shifted? Again, we're talking about the first 6 months of this administration. And what I would tell you, David, and all of our clients is that we remain very watchful and very vigilant for all of the changes that are coming in and out of the administration, of Congress, and ways that those things can impact our portfolio. And we retain the flexibility, particularly in our balance strategies, to be able to overweight and underweight asset classes, strategies, managers. So we have a lot of levers that we can pull. And so we remain diligent. We will remain watchful over your portfolios, knowing that ultimately our strategies to drive competitive performance through our portfolio means more mission and ministry for our clients. And so with that, if there are other questions I didn't get to, I apologize. We will go through the list of those and follow up afterwards. I want to thank all of my colleagues for joining us on the call tonight. And I want to thank all of you, our clients, for the opportunity to be a trusted partner to your institution. I hope that after this 45 minutes together that we are being watchful over the portfolio, and we are being consistent with the values that you've asked us to live out in the ways that we manage these assets. So thank you so much for joining us, and have a wonderful evening.